This is a short update on the Euro-Swiss franc. For those of you that know and follow us, we have been dollar bulls for an extended period. Since the reversal here, we were expecting a bottoming before the run of this low. It came really deep. It actually traded sub 90 on the dollar index, and then we got an inverted head and shoulders. We've been long since 94.5s on a dollar-based strength in the financial currencies, FX markets on cross pairs. Now, this is an end of day, and we're actually trading even lower. I will give you the update on this. The dollar appears to be having its first significant rest. One must remember that even in the strongest markets where there is absolute dominance, and this has been extreme dominance, my friends, since this break, and in actual fact, you could take the neckline from down here and argue that all the way up here has been extreme dominance. Even in extreme dominance markets, the dollar will still rest. In the game of managing financial currencies, as our central banker Heard is prone to do, you will still have periods of counter trend. Never do you abolish the trend. This is more current, and this will actually show instead of being at 103.9, you're at 102.77. So there's a meaningful pullback on the dollar. Remember, we have highlighted the inflation trade and the fear trade. For now, it's considered that all news from the Federal Reserve has been properly baked in. The markets have almost overreacted and gone up, and there is a degree of pullback until new news about tightening, both on the quantitative tightening, which is the amount of liquidity in the system being withdrawn, and the interest rates comes out again. This means your inflation trade comes back on. Remember, you are in a game of ping pong where there is a ball bouncing between two core trading themes. The fear theme, dollar dominance, everything else, risk on, correcting down. And then the inflation theme, which is at the forefront, the energies, which is oil, natural gas, uranium, being some of the most dominant and best for the rally in terms of the inflation trade. You will be in the fear more often than you will be in the inflation trade, whilst there is the tightening cycle commitment and the hawkish statements from the Federal Reserve. This means your dominance of your trading book should be on the fear side, long dollar. However, in these pause periods with pullbacks, if you are to have hedging trades that will later be the core theme and then will become dominant again, this is post a turn in policy, as a reversion to stimulus after creating a recession depression on the consumer, which is probably already here, but they're going to turn that screw a little bit deeper, a little bit longer, a little bit harder. The knife is going to twist a few more times in the wound before the end of this game is concluded. So as a result, during these periods, your inflation trades will start to do well. You will see the oil being bid. You will see the uranium, as I've mentioned, and you'll see other risk-ons. You may get rallies on the stock market to some degree, particularly in the SPY. Typically, in terms of highly overvalued equities with more pain and fear trade to come, I would seize those opportunities for those already not short to take possible shorts. Remember, money management, this is non-advisory. This is what I would do, not what I'm telling anybody else to do. Also, during these periods, the problem that has been debt, you will have pullbacks on the rally. We've already highlighted in a previous clip with regards to why the 3% was such a key zone for the debt structures, and why you will top out, have shooting star, and a pause in the dollar strength theme when create, in our suspicion, most likely a continuation pattern for further upside in the yield. Note, it's the yield, not the value. The value is going down, the yield is going up. This shooting star is, however, likely to cause at least some form of maybe a flagging, or even, if not a flagging, potentially a falling wedge. But in our opinion, will not be a long-term as in months and months, taking you through the summer, a long-term reversal. We expect it to be in the medium-term reversal. One has to remember how much we've done. Doesn't mean it's a short-term reversal. You have done an immense amount on yields from the 0.3, and since this first HVF in a new trend, which was sub 1.5 at these levels, you have broken all the way and run to 3. That is a doubling in yields. That is a great degree of damage to the capital value of debt, which I've used TLT as a regular example. Small hammer here, potential for some degree of reversal in what is a head and shoulder. Don't forget legacy support in and around this zone, and you're likely to get the bid that came in. Note that support range over there. That was the structure for which it sat in during this period. Let's take the arrow. You can see broke through, sat in, sat in, sat in, went up, fizzled back down, sat in, and then made the blow-off highs. This was entirely being driven, and you can see how this happened in the beginning of 2019 and even started before, with concerns about the system and fear. Then we had the repo market crisis around about September, August, October. We were already blasting off. Then you had a small pullback, and then you had the declaration of the events surrounding the item that may not be named. That saw your blow off. Since then, you have come round trip all the way back down. You are in this long structural since 2015. Again, I draw it for you to be absolutely clear. Support zone that has been in play for an extended period. You have a hammer. That means likelihood of some degree of rally coming up here. It could visit, in an extreme case, all the way back to the neckline. Given this momentum, I don't think that's that likely. And again, I would be looking for rising wedges or bear flag structures for opportunities to sell the short further to the downside on later fear and concerns around inflation and rate rises. Why? Because oil keeps staying strong. It is the Rockefeller tax. It was one of the original fuels. He pushed for oil to be in everything, including pharmaceuticals, in getting hold of the pharmaceutical industry as well, the Rockefellers. It's in all forms of trade. It is a tax. You already have a global tax. The oil price is it. And we are holding above 110 on WTI, which is a lot closer to Brent than it is usually. And this is reasonably bullish. We are staying above these 100 levels. I would expect continuation here as well to form in terms of structure. Look at that hammer. As long as that oil price is hammering and likely to go higher, your inflation will go higher, and the reversion and need to further tighten and the aggressiveness of the central bank in America will continue to drive fear and rush to dollar. They are pursuing a dollar dominance policy so that other nations' currencies do not sign up for the new system that Russia and China are putting together, that are seeking to de-dollarize. One of America's defenses will be to lead a bull market in the dollar to encourage holdings of dollars by all neutral states that are losing value in terms of currency and paying a lower yield on their debt. This is to shore up the American debt market and create attractiveness for holding dollars and in instruments that are interest bearing. In an environment that all other risk on assets are going down, it leaves the debt market as an option. If you are correcting overvalued NASDAQ, by the way, even after this correction, the NASDAQ total market cap as a percentage to GDP is still higher than the peak at the dot-com boom. So we went insanely high recently, thanks to, again, the blow-off event that no one sees and is still waiting for, which was the events of March 2020 that saw the better part of 5, 6, 7 trillion, who really knows, being put into the global economy by the Americans, and the killing of the dollar at that point. Since having that glut of dollars, that is now drained away, and as the American consumer dies, as I've already explained, there is less dollars being sent offshore for produced goods from producer nations to the core consumer nation. As a result, internationally, there is actually a dollar shortage, and because of dollar-related debt, additional dollars are needed to service debt beyond just the capital, the interest. And this is typically earned by sending goods the opposite direction. Okay, so oil looks strong. So what this is going to do is keep yields high, and the dollar strength and fear will return. However, if you have a number of dollar-long trades, such as USD Korean Won, USD JPY, remember, at a money management level, you are very, very leveraged. So each individual trades should be sized small if you are having a multitude of the trades. You are continuing to trade the same theme. If you have a USD JPY long, a USD Korean won long, a Euro USD short, it's actually one trade, dollar dominance. You should surmise all your losses on dollar dominance, and that should be that percent that is your maximum allowable drawdown on any trades. If you do not understand money management, you will be cleaned out. You will be feeling pain even on pullbacks, and you'll be feeling uncomfortable. While other people that understand markets will know that's absolutely to be expected. Okay, so what about what I wanted to talk to you about, which was the Euro Swiss franc, rather than these topics I've covered already before, but sometimes feel the need just to reintroduce. So during the period that the dollar dominance is resting, the Euro Swiss franc had been relatively, although it's deeply in profit, underperforming recently. What is happening now is, as the dollar trade is backing off and the dollar is showing weakness, we're seeing the strength come back into the franc as the other alternative strong currency. The Euro Swiss franc trade that we've been talking about was facing a counter rally that continued. You will note that the 105 key level of significance was just run. HVF method, one of its many laws that you would learn about, themarketsniper.com. Go book a call to become a better trader and a better understander of markets. Was resisted. Also, you'll see there's a thin, smaller line. That was the legacy low. I will show you that on a weekly chart many moons ago in terms of legacy low and key round number. So essentially you ran this top. We've taken the 104.90 as the double top, as that was what was touched by the second half of the up leg over here, which also was a rising wedge and broke a basing ascending grind line. That saw a major capitulation. You'll note that this neckline we chose for this double top, so just to make the double top super clear, we are in fact talking about this structure that looks like that. What then ended up is we had a neckline even on double tops. Our necklines are always in the teal blue, and that was at the key round number of 1037. You can see that that was previously resistance twice before being broken and then come back and supported on. So a key level that was resistance later became support, makes up the neckline of this M structure that you see here. As a result of the rising wedge and the exhaustion and the buying up underneath here, eventually puffing out, you get an absence of bid, and you saw a complete capitulation through a 1037, and you got a minor return move rally that was actually rather weak and failed to actually even get the neckline back. Further spill, target made, 1025, target made from the 1049 down to the 1037, 1025. So this suddenly brings, with quite violent momentum, the Swiss franc back into the frame. People were asking, what's happening with your Euro Swiss franc short trade? Well, if you got in from the beginning, you're deep in profit, and it's a long termer, and it will flourish in between the cracks when the dollar is not, because dollar will be the honey badger of dominance when it is dominant, and when it is benign and even pulling back, you will often see then the Swiss franc being favored. And this is exactly what's happening. Also, the Swiss franc does not want to see further correction to the downside against the euro. It'll be held back. They'll do a lot of things in terms of intervention until they can't eat any more puke pies of euros anymore. What tends to happen then is you get a disappointing trade, lots of patience required, and then a dam wall bursting and an absolute capitulation when they say, "Kan nie meer nie, corporaal," can't do it anymore, corporal. And what that means is you then have a dam wall break. So it's nothing, and all your Christmases in one day, week, month, when you have a complete capitulation. This has been typical of the Euro Swiss franc's performance every single time. And that's why trading is for people who are patient to understand the long term. Please remember that these charts were drawn for you on monthly time frames. These things do not become overnight. People say, oh, I haven't got what I wanted out of it. This was the grand macro. This is a monthly time frame. Ignore this, all this density here. I'll remove it in a second. But you can see held, spill. This was held for an inverted HVF for quite an extended period. This was from the subprime crisis in 08. It only broke in 09 December. So again, October, 1.08, a month, 2 months and a year. So 14 months later, it broke. Again with the peg, we had the major capitulation in August. They established the peg roughly here, round about the September period 11, and this actually only broke in 15. So for the better part of 4 years, they built a wall on the beach, held back the tide, stacked sand on the other side of it, only for it eventually to be washed away in all your Christmases in one day. So taking the eye off so that you can see this, what we were highlighting, in fact, I annotated it and I shared this for our premium guys, and I'll let you have a little look in on that in terms of what was happening. Let's just do that. So what you saw is the legacy low at 105 over there, running. That was the legacy low before a major channel churn up. 2 major attempts to break out that were on the top side. You couldn't hold the top floor for very long. Most of the time you were grinding in the lower end. You gave up on that basing ascending grind line only to, let me just grab this, I need my draw tool, only to subsequently fail. Here you can see it, eventual fail, little bit of a bounce, fail, return move to the grind line, and then spiller, absolute thriller. You took out the 105 and actually ran the 103. Snapback rally that took you back above the 105, down, down, down. Now you've done a rising wedge to the 105 with a pop out the top that just runs the 105, the legacy low. This was previous support for the euro Swiss franc that saw a substantive rally for a sustained period that was only broken a lot later, and now that is resistance. You're selling off hard. I expect a little bit more grinding and then another down leg to take place. Remember, this is a monthly chart. Doesn't mean it's going to happen tomorrow. This is a patience, long-termer, monthly chart where the bias is short, short, short. So the reminder of where the original entry was in terms of this trade. You should have been, if you'd been with us in our premium community, this was the funnel when we were engaging here, and we got in early on this. We didn't wait for that. So you have been short all this period, and you have faced a small rally for now. Whoops, let's get that eraser there. A small rally for now that is now turning into a shooting star after a hammer. That negates the reversal nature of the hammer. Why did you get that hammer there? Why did it happen? That's a point I failed to mention when I brought up this jaw. You ran the parity level. It was making headlines. Central bankers don't like headlines. And we warned that when you run parity, you would likely rally. So key level of significance, just run, likely rally. Key level of significance, just run, on resistance, likely sell-off. You see the principles of price behavior. A spiller, a thriller, key level, just run, expect a rally. Your trade will underperform for a period. Rally, 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 bounce up to a key level, likely to come back into the game. You have to trade to levels. You must not be a momentum chaser. Momentum chasers chase in short at the parity run and go, damn, I should have been in this trade earlier, only to eat red for a sustained period and close the trade when it's getting up to these levels and say, oh, it's not a good thing. You need to be absolutely different. You have to be truly contrarian, and contrarian not I'll just do the opposite to sentiment, but contrarian with reasons, with geometry, with charting, with key understanding of market price behavior. That is the benefit. That was your best chance to break into this trade, just gone. And now you have already seen an absolute spill down. There will be possibly further rallies, but that will come lower down. I don't think you'll see 105 again. Could be wrong. We're talking about the future. I haven't been there yet. I'm sure I'll get there one day. But in terms of probabilities and possibilities, I don't think that we see 105 again. And I think this rising wedge in time, which can be quite lengthy on a monthly chart, resolves to the downside and will lead to possible further structure setting up for a deeper dive below the parity level. But remember, this can take a while, and then suddenly all your Christmases in one day. This also, as a trade, is a perfect hedge to a lot of dollar longs, because as you are pulling back on your dollar longs on your P&L, I hope you haven't been adding along the way and blowing your money management, you at least get this trade giving you some P&L at a point when your dollar trade isn't. So it is more neutralizing and balancing your overall P&L. Do not trade your P&L, trade the chart. Do not trade your P&L, trade the chart. People that trade their P&L lose money, keep chasing in, and forget about money management and do not understand the technical levels. If the chart is right, stay with the trade, keep your sizing small so that you can be in there, know what your maximum loss is, do not be tempted into irresponsible trading at any point. Again, non-advisory at all levels. But this little shooting star after that little hammer will set up further downside moves, and I believe this will continue to perform again for those that are in the trade. So we've been in this since in and around the 2011 period. So that shooting star, let's actually just do it with this. We're on the monthly time frame. So you should have been in here since September of last year, and you should still be in, and you should be holding. Your stop should be up top there at 109. You should have gone in with us with 108s, and we are expecting further downside. The structure that you are trading is in fact that structure with this draw. The Eurozone will have huge troubles. It will have extremely high inflation. It is a welfare state. They will need to be highly quantitatively orientated in terms of easing for what will be all sorts of debt-related problems, all sorts of consumer inflation-related problems, reduced tax take in a crushed consumer. They're going to be very aggressive on taxation and capital gains. Inflation will give a lot of fake capital gains on the basis of devalued money, and as a result, you should always, and we're getting a surge of people that are coming through our Reset Sniper portal. Some people don't want to be part of learn how to do HVF method. Some people aren't interested in cryptos right now while they're down. Those are our Market Sniper and Crypto Sniper brands. But lots of people are realizing totalitarianism and overreach by government is coming. Those of you that do not have structures, do not have capital gains protection, do not have a community that is like-minded, that is protecting from overreaching World Health Organization, overreaching taxation. They're seeing the transnationalization of entities across borders. Suddenly realize I need to think about protecting my family, my wealth, in a time when we are going to have the reverse Greenspan Goldilocks economy. It's going to be all the three bears now versus Goldilocks, and as a result, the extractors are coming to hollow the middle classes, the upper middle classes, and the working poor right out to the benefit of the billionaire classes, with their pump and dump schemes, their capital gains taxation, and various other forced compliance of a medical and many other freedom of movement related issues. Reset Sniper, people are contacting us. Help us be better ready for Reset Sniper. If you're one of those people, you can send a mail to support@themarket sniper, and we'll discuss with you all our structures, what we can do to support you in all of this. This particular video is about the Euro Swiss franc and the value of it as an alternative short trade during dollar dominance periods. In the windows it will flourish, and a reminder that you get all your Christmases suddenly in one day on the crashamentals. And even here, 4 or 5 months after holding in this trade for an extended period, although you were getting regular gains here, the best part of the profit P&L came in a 5-month window, and then you sat for the better part of 5 years without much, and then all again. So macro trading requires patience. Macro trading requires patience. Both these currencies have very, very low interest rates. You should not be facing a high carry cost, and as a result you should be able to stay net short on the Euro Swiss franc. Okay, if you enjoyed these shorter updates, give us a like and a share. We continue to wish to build our YouTube following and anything else. Share us through Twitter. We appreciate people that are supporters. We aim to give you something for free, value, true potential alpha, and if you're in any way grateful, shares are great currency, and we thank you for that. Until the next time we speak again. Bye for now.